All right, let's talk about accounting. Riveting stuff, I know, but buckle up because today we're diving headfirst into the thrilling world of IFRS 9, the accounting standard that's shaking things up like a rogue calculator at a tax audit. Now, IFRS 9, or International Financial Reporting Standard 9, might sound like a droid from Star Wars, but it's actually a set of rules that dictate how companies report their financial assets and liabilities. Think of it as the grammar police of the financial world, making sure everyone's using their commas and semicolons correctly, only instead of commas, it's billions of dollars. This standard, which replaced the outdated IAS 39 back in 2018, has been causing quite a stir in the financial world. We're talking major changes to how companies classify, measure and report their financial instruments. And by major changes, I mean enough to make your average spreadsheet spontaneously combust. So whether you're a seasoned CFO or just starting your accounting journey, get ready for a wild ride as we break down everything you need to know about IFRS 9. Let's start with the basics. IFRS 9 is like the cool kid in school who shows up one day and changes everything. It's all about recognizing potential losses from financial instruments before they actually happen. It's like predicting the future, but instead of crystal balls, we're using spreadsheets and algorithms. Fun, right? The old standard, IAS 39, was all about reacting to losses after they occurred. It was like showing up to a fire with a bucket of water after the house had already burned down. Not exactly helpful. IFRS 9, on the other hand, is all about being proactive. It's like installing a sprinkler system and hiring a team of highly trained fire-sniffing dogs. You're prepared for anything. The key to this whole thing is something called the expected credit loss model. It's a fancy way of saying that companies need to estimate the losses they might incur on their financial assets like loans and bonds. It's like trying to figure out how much your car insurance will cost based on your driving record, but instead of speeding tickets, we're talking about economic downturns and market crashes. Now you might be thinking, why do I care about all this accounting mumbo-jumbo? Well, here's the thing. IFRS 9 has a huge impact on how companies report their financial performance. It affects everything from their profitability to their capital adequacy ratios. And trust me, those are two things investors care about a lot. So whether you're a business owner, an investor, or just someone who enjoys a good accounting debate, it's time to get familiar with IFRS 9. Because this isn't just about numbers on a page, it's about understanding the real-world impact of financial reporting. Okay, so we've established that IFRS 9 is a big deal, but you might be wondering if it applies to you. Well, if you're a company that holds financial assets, the answer is probably yes. And by financial assets, I don't just mean stacks of cash hidden under a mattress. I'm talking about loans, bonds, investments, basically anything that has the potential to make or lose you money. Banks, for example, are all over IFRS 9 like bankers on a bonus day. It's no surprise, really, since they're dealing with loans and mortgages left, right and centre. But it's not just banks that need to comply. Insurance companies, investment firms, even your average publicly traded company, if they're dealing with financial instruments, IFRS 9 is coming for them. Think of it like this. If your company's balance sheet looks like a Jackson Pollock painting with financial instruments splattered all over it, you're going to need to get real familiar with IFRS 9. It's not a suggestion, it's a requirement, and the last thing you want is to be caught off guard by the accounting police. Now, I know what you're thinking. This sounds expensive, and you're not wrong. Implementing IFRS 9 can be a costly and complex process, but here's the thing. The cost of non-compliance is even higher. We're talking fines, penalties, and a whole lot of bad press. It's enough to make you wish you'd paid more attention in accounting class. So the bottom line is this. If you're handling financial instruments, don't bury your head in the sand and pretend IFRS 9 doesn't exist. Embrace the chaos, get your spreadsheets in order, and prepare to dive into the wonderful world of expected credit losses. So we've covered the what and the who of IFRS 9. Now let's get into the nitty-gritty of the how. Because IFRS 9 isn't just a minor tweak, it's a full-blown overhaul of the way companies account for their financial instruments. Imagine taking your old clunker of a car and swapping out the engine, the transmission, and the suspension all at once. It's going to drive differently, and you're going to need to learn how to handle it. First up, we've got the classification and measurement of financial assets. IFRS 9 introduces a new model based on you guessed it, the business model, and the characteristics of the cash flows. It's like sorting your socks based on color and fabric, only instead of socks, it's millions of dollars. Then there's the impairment model, which, as we've discussed, is all about recognizing those expected credit losses. This is where the ECL model comes in, and trust me, it's a whole other can of worms, but don't worry, we'll be diving deep into that later. And finally, we have hedge accounting, which is about as much fun as it sounds. IFRS 9 makes some significant changes to the way companies can account for their hedging activities, and let's just say, it's not for the faint of heart. Now, I know this might all seem overwhelming, but bear with me, because once you understand the key changes introduced by IFRS 9, you'll be well on your way to mastering this complex standard. It's like learning a new language. It takes time, effort, and probably a few frustrated tears, but in the end, it's worth it. Chapter 4, the expected credit loss, ECL. Model predicting the future of your finances. All right, let's talk about the elephant in the room, the expected credit loss, ECL, model. This is the heart and soul of IFRS 9, the part that's got everyone in a tizzy. It's like trying to predict the weather, but instead of rain clouds, we're looking at economic indicators and market trends. The ECL model has 3 stages, each more ominous than the last. Stage 1 is all about those initial losses you expect when you first hand over your money. It's like that sinking feeling you get when you realize you just paid twice the market price for a used car. Stage 2 kicks in when there's a significant increase in credit risk. Think of it like that moment when you hear a strange noise coming from your car engine and you know it's going to cost you. And then there's stage 3 where the losses are so bad, it's like your car has burst into flames and you're standing there with an empty fire extinguisher. Now, I know what you're thinking. How on earth am I supposed to predict the future? And you're right, it's not an exact science, but IFRS 9 requires companies to use all available information, including historical data, current economic conditions, and even their own crystal balls. Okay, maybe not crystal balls, but you get the idea. It's all about making the best possible estimate based on the information you have. The ECL model is a major departure from the old incurred loss model. It's like trading in your old flip phone for a smartphone. It's more complex, it requires more data, and it might make you want to tear your hair out at times, but it's also more sophisticated and, dare I say, more accurate. Chapter 5. Significant increase in credit risk. When should you start panicking? Buckle up, folks, because we're about to delve into the thrilling world of credit risk. Specifically, what constitutes a significant increase in credit risk under IFRS 9. It's like trying to define reasonable doubt in a court of law. It's subjective, it's open to interpretation, and it's probably going to give you a headache. Now, IFRS 9 doesn't exactly give us a clear-cut definition of what constitutes a significant increase in credit risk. It's more like they threw a bunch of vague guidelines at the wall and said, good luck figuring it out. Helpful, right? But fear not, dear viewers, because we're going to break it down for you. Essentially, you need to consider any changes in a borrower's ability or willingness to repay their debt. Think of it like this. If your friend who always forgets their wallet suddenly starts asking you for bigger and bigger loans, that's a red flag. Similarly, if a company starts showing signs of financial distress, like declining profits or missed payments, that's a sign that their credit risk might be increasing. But it's not just about financial data. IFRS 9 also requires companies to consider qualitative factors like changes in management, industry trends, and even political instability. It's like trying to solve a complex puzzle where each piece of information provides a clue to the bigger picture. Determining a significant increase in credit risk is a judgment call. There's no magic formula or easy answer. It requires careful analysis, sound judgment, and maybe a stiff drink or two. But hey, that's the exciting world of IFRS 9 for you. Chapter 6, IFRS 9 and Financial Instruments, a match made in accounting heaven or hell. Let's talk about financial instruments, shall we? Those magical pieces of paper, or more accurately digital entries, that represent everything from loans and bonds to derivatives and equity investments. IFRS 9 has a lot to say about how these instruments are recognized, measured and reported, and let's just say it's not for the faint of heart. Under IFRS 9, Companies need to carefully consider the characteristics of each financial instrument and how it fits into their overall business model. It's like trying to fit different shaped blocks into their corresponding holes, only if you get it wrong, you could end up with a financial statement that looks like a Picasso painting. One of the biggest changes introduced by IFRS 9 is the move away from the incurred loss model for impairment to the ECL model, which we've already discussed ad nauseum. This means that companies now need to recognize expected credit losses much earlier, which can have a significant impact on their financial statements. But it's not just about impairment. IFRS 9 also introduces new rules for hedge accounting, which is a complex area of accounting that can make even the most seasoned finance professional break out in a cold sweat. Essentially, hedge accounting allows companies to offset the volatility of certain financial instruments, but the rules are notoriously complex and difficult to apply. So if you're dealing with financial instruments under IFRS 9, be prepared to roll up your sleeves and dive into the details. Because the devil is in the details, and in the world of IFRS 9, there are a lot of devils running around. Chapter 7, IFRS 9 and banks, a love-hate relationship. Banks, those bastions of financial stability and prudence, or are they? When it comes to IFRS 9, banks have a particularly complex relationship with the standard. It's like that couple that's constantly fighting but can't seem to live without each other. You see, banks are heavily impacted by IFRS 9 because, well, they deal with a lot of financial instruments. Loans, mortgages, bonds, derivatives. You name it, banks are swimming in it. And because IFRS 9 requires banks to recognize expected credit losses much earlier than before, it can have a significant impact on their profitability and capital adequacy ratios. Imagine a bank is like a ship sailing on the open ocean. IFRS 9 is like the weather. It can be unpredictable and unforgiving. A sudden storm, like an economic downturn, can rock the boat and cause some serious damage. That's why banks need to be prepared for anything. One of the biggest challenges for banks under IFRS 9 is the sheer volume of data they need to collect and analyze. Think of it like trying to drink from a fire hose of information. It's overwhelming, it's messy, and it's easy to get lost in the deluge. But it's not just about data. Banks also need to make significant changes to their systems, processes, and even their corporate culture to comply with IFRS 9. It's like trying to turn a cruise ship around in a bathtub. It takes time, effort, and a whole lot of coordination. Chapter 8, Implementing IFRS 9, a walk in the park, Jurassic Park that is. Alright, let's be honest, implementing IFRS 9 isn't exactly a walk in the park. It's more like trying to assemble a 1,000-piece jigsaw puzzle while riding a roller coaster. It's challenging, it's chaotic, and there's a good chance you'll end up feeling slightly nauseous. One of the biggest hurdles is data. IFRS 9 is a data-hungry beast, and it requires companies to gather, clean, and analyze vast amounts of information. It's like trying to find a needle in a haystack, except the haystack is made of spreadsheets, and the needle is a specific data point that you need to calculate your expected credit losses. Then there are the systems. Many companies are finding that their existing systems aren't equipped to handle the complexities of IFRS 9. It's like trying to run the latest video game on a computer from the 1990s. It's just not going to work. And let's not forget about the people. Implementing IFRS 9 requires a significant amount of training and expertise. It's like trying to teach a group of toddlers how to play chess. It's going to take time, patience, and a lot of repetition. But perhaps the biggest challenge of all is the judgment involved. IFRS 9 is full of subjective areas that require companies to make their own interpretations and assumptions. It's like trying to navigate a minefield of accounting standards where one wrong step could have explosive consequences. Chapter 9. Prepping for IFRS 9. Your step-by-step guide to not completely losing it. So you need to comply with IFRS 9. Congratulations, you've officially entered a world of spreadsheets, data analysis, and enough accounting jargon to make your head spin. But fear not, dear viewer, because I'm here to guide you through the treacherous path of IFRS 9 implementation. Think of me as your trusty Sherpa. Only instead of oxygen tanks, I'm armed with PowerPoint presentations and a healthy dose of cynicism. Step 1. Assess the damage. Before you even think about implementing IFRS 9, you need to understand how it's going to impact your organization. This means reviewing your existing processes, systems, and data to identify any potential gaps or areas of concern. It's like going to the doctor for a checkup, only instead of checking your blood pressure, we're checking your accounting standards. Step 2. Get your house in order. Once you know where you stand, it's time to start making changes. This could involve anything from upgrading your IT systems to retraining your staff. Think of it like renovating your house. Only instead of knocking down walls, we're revamping your accounting policies. Step 3. Embrace the data. IFRS 9 is all about data, and more data. You're going to need to collect, clean, and analyze vast amounts of information to comply with the standard. It's like becoming a digital hoarder, only instead of collecting old newspapers, we're collecting financial data points. Step 4. Don't be afraid to ask for help. Implementing IFRS 9 is a complex undertaking, and there's no shame in seeking assistance from experts. Think of it like hiring a personal trainer for your accounting department. They'll whip you into shape and make sure you're ready for the big day. Chapter 10 is just IFRS 9, avoiding the biggest blunders, because we've all been there. Listen, we've all made mistakes. I once spent an entire week researching the mating habits of the Patagonian Mara, only to realize I was looking at pictures of a very large guinea pig. But when it comes to IFRS 9, mistakes can be costly. So let's take a look at some of the most common blunders and how to avoid them, shall we? Mistake number 1. Underestimating the data challenge. IFRS 9 is a data-hungry beast, and many companies make the mistake of underestimating just how much information they need to collect and analyze. It's like going on a road trip without a map. You might eventually get there, but it's going to be a bumpy ride. Mistake number 2, ignoring the importance of systems. IFRS 9 requires sophisticated systems to handle the complex calculations and reporting requirements. Ignoring this is like trying to run a marathon in flip-flops. You're setting yourself up for failure. Mistake number 3, forgetting about the human element. Implementing IFRS 9 isn't just about technology and data, it's also about people. Companies that fail to train their staff properly are likely to encounter problems down the line. It's like trying to build a house without any construction workers. It's just not going to end well. Mistake number 4, thinking of IFRS 9 as a one-time project. IFRS 9 isn't a one-and-done deal, it's an ongoing process that requires continuous monitoring and improvement. It's like owning a pet. You can't just feed it once and expect it to thrive. Chapter 11. IFRS 9 and your financial statements. Expect the unexpected and some volatility. Financial statements, those beloved documents that investors pore over with the intensity of a hawk eyeing its prey. But be warned, dear viewer, because IFRS 9 has the potential to turn your once predictable financial statements into a roller coaster ride of volatility. It's like watching a Michael Bay film. Expect explosions of numbers and more twists and turns than a game of Twister. One of the biggest impacts of IFRS 9 is on the recognition of expected credit losses. Remember the ECL model? Well, it requires companies to recognize losses much earlier than before, which can lead to some wild swings in profitability. Imagine your income statement as a serene lake. Now, picture IFRS 9 dropping a giant boulder into the middle of it, causing ripples of volatility that spread throughout your financial statements. But it's not just about profitability. IFRS 9 can also impact the way assets and liabilities are reported on the balance sheet. Think of your balance sheet as a delicate ecosystem. IFRS 9 is like introducing a new species into the mix. It can have unforeseen consequences and disrupt the balance of power. Now, I know what you're thinking. This all sounds terribly alarming, and you're not wrong to be concerned. But here's the thing. IFRS 9 is all about providing a more accurate and transparent view of a company's financial position. It's like swapping out your old blurry glasses for a pair with high-definition lenses. The world might seem a little more chaotic at first, but ultimately you're seeing things more clearly. Chapter 12. Conquering IFRS 9 Best Practices for Long-Term Success and Sanity. So you've made it to the end of our IFRS 9 journey. Congratulations. You've braved the complex world of accounting standards, navigated the treacherous waters of data management, and emerged from the other side, perhaps a little worse for wear, but hopefully with a newfound appreciation for the intricacies of financial reporting. But your IFRS 9 journey isn't over yet. Oh no, my friend, this is a lifelong commitment, but fear not, because I'm here to arm you with some best practices to ensure your long-term success and sanity. Think of these as your IFRS 9 survival kit. Best practice number 1, embrace continuous improvement. IFRS 9 isn't a one-time project, it's an ongoing process. Regularly review your processes, systems and data to ensure you're still on track. It's like going to the dentist for regular checkups. A little preventative care goes a long way. Best practice number 2, become a data ninja, IFRS. 9 is all about data, so get comfortable with it. Invest in robust data management systems and processes to ensure your data is accurate, complete and readily available. Think of data as your secret weapon in the fight for IFRS 9 compliance. Best practice number 3, don't be afraid to ask for help. IFRS 9 is complex, and there's no shame in seeking assistance from experts. Think of it like hiring a Sherpa to guide you through the Himalayas of accounting standards. Best practice number 4, stay informed. The world of IFRS is constantly evolving, so stay up to date on the latest developments and best practices. It's like trying to keep up with the Kardashians. It's a full-time job, but someone's got to do it. Outro IFRS 9, embrace the chaos, conquer the future. So there you have it, your crash course in IFRS 9. We've covered everything from the basics of the standard to the complexities of implementation and beyond. It's been a wild ride, hasn't it? We've laughed, we've cried, we've questioned our sanity, but ultimately, IFRS 9 is about more than just numbers on a page. It's about improving financial reporting, enhancing transparency, and creating a more stable and resilient financial system. It's like a financial boot camp. It's tough, it's demanding, but it's designed to make you stronger and more prepared for the challenges ahead. So go forth, dear viewer, and embrace the chaos of IFRS 9. Because in the world of finance, the only constant is change, and those who can adapt, evolve, and conquer the complexities of IFRS 9 will be the ones who thrive in the years to come.